Happy Tuesday out there, Team 42. It's your skipper here, Darius to present our macro minute for Tuesday, July 15th, 2025. As always, we'll start with the executive summary from today's leadoff morning note. If you would like to review the analysis supporting these conclusions and to see if you need to make any changes in your portfolio to remain on the right side of market risk, you need to be a client of 42 Macro. So today's key macro question is, are tariffs showing up in the inflation data? Our answer, yes. Core goods CPI contributed 15 basis points to headline CPI in June, the most since July 2023. After months of somewhat perplexing disinflation, enough to rouse fears of book cooking among Wall Street economists and the WSJ, Wall Street Journal, inflation did what we thought it would do all along, which is fail to durably break down below trend without an actual recession. The muted market reaction to the July CPI print is in line with how we've been guiding Team 42 to interpret inflation data for months. For our fundamental research summary, U.S. inflation is unlikely to durably return to the Fed's stated 2% and de facto 2.5% targets without an actual recession. Since last summer, our grid model has been forecasting an uptrend in inflation throughout 2025. Since both the Fed and Wall Street consensus have fully capitulated into our view, we no longer anticipate upside surprises over the medium term. No upside surprises equals limited market risk. No change to this carefully constructed, data-driven research view. Elsewhere, according to the latest Bank of America Fund Manager survey, investor risk appetite surged with the biggest 3-month jump in high-risk portfolio allocations since 2001, with tech stock exposure notching its sharpest 3-month climb since March 2009, per the same poll. If the phrase 3-month jump sounds fishy to you, then good, because it sounded fishy to us too. Recall that in the Bank of America Fund Manager survey released in early April, fund managers were net 36% underweight U.S. stocks, down from 17% overweight in early February, the biggest ever 2-month drop. In the early May Bank of America Fund Manager survey, fund managers were net 38% underweight U.S. stocks, which was the lowest allocation in 2 years. It seems our friends at Bank of America are eager to convey that their prime brokerage clients were on the right side of our near 3-month-old paradigm C view, when in fact they were not. They have, however, aggressively narrowed the gap over the past month plus, and that makes us cautious regarding the next 2 to 3 months, given the quantitative evidence of upside capitulation that we discussed in our July 12th around the horn. Regarding the medium to long term, we remain steadfastly bullish as the architect of the paradigm C theme, and amid qualitative evidence that is yet to be fully understood by investor consensus and quantitative evidence that is yet to be fully positioned for as a result. Transition to our 42 macro dashboard. As always, wrap up the question from our community. This one's not really a question, more of a comment, but certainly worthy of unpacking. Says, hi, Didi, a new subscriber here. Saw Darius on Adam Taggart's pod and loved his analysis and framework. In particular, I saw a lot of value in using KISS for my client. I personally don't use KISS as I'm much more risk exposed, but I find the framework and indicators a great risk indicator. I'm adapting my allocations based on KISS, but won't use the exact allocations due to my current exposures, as well as my overall technological macro theses. So the reason I wanted to flag this comment, because I think it's this subscriber, this client, is using KISS perfectly. I mean, so there, when we say we have thousands of investors around the world participating in our KISS portfolio construction process, I'm guessing some large percentage of them are just executing the standard 60-30-10 stocks, gold, Bitcoin portfolio, which we add our top-down and bottom-up risk management overlays to risk manage each of those exposures in terms of raising cash or increasing our exposure to those 3 asset classes vis-a-vis the SPLG ETF, GLDM ETF, and FBTC ETF, so stocks, gold, Bitcoin. There is, however, a meaningful enough segment of our community that is using the signals generated by our KISS portfolio construction process to manage risk broadly. So one of the core features of our KISS process is that we communicate at all times exactly what percent of KISS's maximum exposure to each to cash, what percent of KISS's maximum exposure it has to stocks at that particular juncture, what percent of its maximum exposure it has to gold at that particular juncture, and what percent of its maximum exposure that it has to Bitcoin at that particular juncture. We have clients who are focused specifically on stocks, so they're using that KISS percent of maximum exposure signal to guide their exposure. Let's say they're managing a 401k and they don't have gold or Bitcoin in their 401k. They can still take that percent of maximum exposure statistic and apply it to their own equity exposure. Same for gold, same for Bitcoin. So KISS, and then obviously for cash as well, in terms of percent of maximum exposure to cash. So that statistic, we're publishing those statistics, every day. And if they change, we obviously flag that via notifications to our client base. Another way in which investors are using our KISS system to their own customized liking is swapping out the exposures. Let's say you're not as convinced on the qualities and the upside risk. You're not as convinced on Bitcoin as we are here at 42 Macro, or maybe you want more yield from the overall KISS portfolio than it is currently providing with its exposure to gold and Bitcoin, two non-yielding assets. We have clients who are using our discretionary risk management overlay, aka Dr. Mo, to guide their exposure to fixed income in the context of their own customized KISS portfolio, or to guide their exposure to, let's say, I don't know, crude oil, silver miners, gold miners, Ethereum, Solana, all these other different types of exposures that you can be having. Let's say you don't want U.S. equities, you want international equities, you want small caps, you want NASDAQ stocks. These are all choices that you can make as an investor. Just to be aware that what we're providing here, not only in addition to our standard KISS portfolio, that pie chart asset allocation, that dynamic pie chart asset allocation, in terms of helping clients who don't want to customize KISS, obviously very effective. We talked about how effective that was yesterday in our Around the Horn on Saturday, which we published a clip bar on social media. But KISS is just as effective to the extent you want to customize. Because what we're really selling here are risk management guardrails that prevent you from making grave mistakes in your portfolio by allocating assets to the wrong asset classes at the wrong time in the market cycle. That's what are the systematic overlays that we feature in KISS and Dr. Mo. That's what they're really, really good at doing, is chopping off the left tail of the distribution by making sure that you're in cash and not exposed to assets that are breaking down and increasing in volatility and covariance, and you're getting increasingly exposed to assets that are breaking out and decreasing in volatility and covariance. And so that, in my opinion, is one of the many ways in which I'm really glad for this particular comment, because it allows us to embellish the fact that, hey, we have clients here who aren't necessarily just wedded to our 60-30-10 stocks gold Bitcoin portfolio. There's a tremendous amount of value in what we're signaling across the entire KISS infrastructure and vis-a-vis Dr. Mo for clients to actually come in and generate a customized solutions for their own portfolio, their own strategic investment objectives. And so just be aware of that. If you're sort of circling us, kicking the tires on 42 Macro, just be aware that, hey, even if you're not fully bought into the current KISS portfolio, which I think you should be, Paul Tudor Jones gave us the rubber stamp, one of the best investors of all time. But if you're not, then definitely you can customize KISS to your liking. So I want to hammer that point home, just piggybacking on what we discussed in yesterday's Macro Minute. So we'll wrap it up there. Darius still here presenting our Macro Minute for Tuesday, July 15th, 2025. Best of luck out there today. We'll catch you back here tomorrow. Cheers.